Welcome back to the Daily Crypto Deep Dive. Today we're going to do something people in crypto don't do often enough. We're going to remember what actually happened with FTX. Not the memes, not the courtroom headlines, but the mechanics. And then we're going to ask the uncomfortable question. If something like that happened today, not to a mid-tier exchange, but to the biggest player in the room, to Binance, what would it look like? How fast would it happen? Who would get hit first? What would regulators do? And what would it mean for the rest of the market that thinks it's decentralized and therefore safe? Because it's easy to say that was a one-off. But market history says none of these things are ever really one-offs. They're stress tests. FTX was the stress test of 2022. The question now is whether the system that exists in 2025 could withstand the failure of a much bigger node. Let's start by rolling the tape back. FTX, at its peak, wasn't just another exchange. For a while, it was the exchange that made crypto look grown up. It had slick branding, a US arm, institutional products, venture money from the biggest names in Silicon Valley, Super Bowl ads, stadium naming rights, politicians smiling in photos, all of it. The whole, we are the responsible crypto company image. Underneath that polish was a very old-school problem. Customer money was not being kept where customer money was supposed to be kept. FTX and its trading firm, Alameda Research, were not properly separated. Funds deposited by users to trade spot or futures were being rehypothecated. In plain English, reused, to backstop Alameda's positions. That is the one red line every regulated financial system enforces. Client money is sacred. The moment you mix it with house money, you become fragile. The trigger was a piece of information. In early November 2022, CoinDesk published a leaked Alameda balance sheet. It showed that a large part of Alameda's equity was actually FTT, the token created by FTX itself. That meant Alameda's solvency depended on the market valuing a token FTX had printed. You don't need to be an analyst to see the circularity there. If FTT went down, Alameda's balance sheet went down. If Alameda went down, FTX had a hole. If FTX had a hole, customers were at risk. And that was before anyone started selling. Then came the tweet that lit the match. Binance CEO Changpeng Zhao, CZ, said Binance would liquidate its remaining FTT holdings due to recent revelations. That was not a random account posting. That was the largest exchange in the world saying, "We see risk here, and we're getting out." Markets heard that as, if Binance is exiting, I should exit too. Withdrawals from FTX surged. In 48 hours, users tried to pull billions off the platform. FTX did not have the liquidity to meet those withdrawals because a big chunk of the assets were either locked, lent out, or sitting in FTT. What should have been an exchange that could handle a bank run turned out to be a trading firm, disguised as an exchange. Within days, FTX paused withdrawals, sought emergency funding, briefly announced a non-binding acquisition by Binance, and then collapsed into bankruptcy when Binance walked away after seeing the books. That was the FTX story in the shortest, honest version. Too much leverage, too much related party exposure, and no real segregation of client assets. That combination is fatal in traditional finance, and it was fatal in crypto. Now let's fast forward to today and change one variable. What if the name in that story isn't FTX, it's Binance? And to be very clear here, we are talking hypothetically. We are not saying Binance is insolvent. We are not saying Binance is FTX. We are not saying Binance is doing what FTX did. What we are doing is what risk people do. We are wargaming the scenario. If the biggest, most systemically important exchange in crypto were suddenly questioned the way FTX was questioned, how would the market behave? That question matters because Binance, unlike FTX, sits in the middle of almost everything. Spot liquidity, futures open interest, altcoin listings, stablecoin flows, launchpads, even on and off ramps in parts of the world where banking for crypto is still fragile. Taking Binance out of the picture, even for a week, would not be like taking one exchange offline. It would be like removing a piece of plumbing from inside the wall and expecting the water to keep running normally. So let's run the scenario in stages. Stage 1, the doubt. With FTX, doubt was triggered by a leak. With Binance, Doubt could be triggered by something as simple as a regulatory filing, an unsealed indictment, a big-name auditor stepping away, or a credible report that the exchange's global liquidity books were more interlinked than advertised. In 2023, we had a small taste of this. When the US CFTC and SEC filed cases against Binance entities and CZ, there were brief waves of withdrawals. But the platform survived because users believed the core business was solvent, and because Binance processed withdrawals quickly. In our hypothetical, imagine the story is bigger. Imagine a claim that Binance has a large hole, or that a major jurisdiction has ordered assets frozen, or that a key banking partner has cut them off. The very first response from users would be identical to FTX. Withdraw now, ask questions later. People don't wait for the second article. They move the moment the first one lands. Stage 2. The rush. Binance's daily volumes are still the largest in the world. Even after competitors like OKX, Bybit, Coinbase, and the Hong Kong platforms have gained ground, Binance handles eye-watering amounts of spot and derivatives activity. A real loss of confidence there would mean tens of billions of dollars in withdrawal requests inside 24 hours. Even if Binance were 100% solvent, the operational stress alone, blockchain congestion, banking rails, KYC queues, would make the experience feel like a crisis. And in markets, feeling like a crisis is enough to become a crisis. On-chain watchers like Nansen and Arkham would start posting outflows from Binance hit X billions, and that would create more exits. You'd see social media flood with "I got my money out" screenshots, which instantly creates FOMO for safety. Centralized exchanges live and die on that perception. I can get my money out. The moment users think they can't, even if they still can, trust starts falling faster than the numbers. We'll take a short pause here, and when we come back, we'll dig into exactly how the fallout could unfold in real time.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
All right, taking a breath for a second. Now let's look at how that kind of panic would start spreading through the rest of the market. Stage 3. Liquidity shock across altcoins. This is the part people forget. When FTX collapsed, it wasn't just FTT that dumped. Tokens that were primarily listed or most liquid on FTX, Serum, Solana perps, many low caps, saw their market depth vanish. Now scale that up to Binance. Binance is the primary liquidity venue for hundreds of long-tail altcoins and meme tokens. A Binance stress event would mean order books on those pairs go paper thin in seconds. Prices would gap, arbitrageurs would try to smooth it, but many pairs would just go no bid for stretches. Traders who think, well, I can always just sell to USDT would discover that in stressed conditions, slippage is brutal. This is exactly why, after FTX, a lot of funds moved to a multi-venue approach to avoid being trapped on a single CEX. On Binance, this would be 10 times bigger. Stage 4. Stablecoin disruption. Binance also sits in the middle of stablecoin routing. Even after BUSD was wound down, Binance became a major venue for USDT, USDC, and regional stablecoins. In an FTX-style panic, users don't just pull crypto off an exchange, they pull dollars, which in this world means stablecoins. You'd see a spike in on-chain transfers from Binance wallets to self-custody, to Tron, to Solana, to exchanges perceived as safer. You'd also likely see temporary depegs on some stablecoin/stablecoin pairs on Binance as internal liquidity thins out. The good news is that by 2025, stablecoins are far more battle-tested than they were in 2022, and there's now far more off-exchange liquidity for them. But for a few hours, it would still feel chaotic. Stage 5. Derivatives and funding. One of the things that made FTX's collapse so dramatic was that it was a huge player in perps. Binance is even bigger. A sudden stop in Binance derivatives, even just a temporary risk control pause, would shove traders toward Bybit, OKX, and CME, likely widening spreads and spiking funding. Perps would briefly trade dislocated between venues, risk engines would trigger forced deleveraging, and you'd get the kind of intraday volatility that makes headlines. Bitcoin drops 6% in 15 minutes. That's not because Bitcoin broke. It's because one of its biggest trading pipes got kinked. Now the natural question, would this be another FTX? And the honest answer, based on what we've seen since 2022, is it would be bigger in impact, but different in nature. FTX was fundamentally insolvent. It didn't have the coins. Binance from everything public, regular proof of reserves attestations, large on-chain balances. The fact it handled previous waves of withdrawals looks more liquid and more operationally prepared. It also had to clean up a lot of its structure after its US regulatory settlements. That matters. It means a Binance event today would likely be more of a confidence event than an asset shortfall event. In other words, the problem wouldn't necessarily be the money is gone. It would be, I don't know if the money is fully there, so I'm taking mine out. And that kind of event recovers faster if withdrawals are processed and if communications are strong. But let's push the hypothetical further, because you wanted the what if it actually broke version. Suppose Binance did turn out to have a hole, not necessarily because of fraud like FTX, but because of, say, a big seized wallet, a surprise multi-billion regulatory fine with immediate payment terms, or a bad counterparty exposure. What then? First, regulators would move faster than they did with FTX. After FTX blew up, every major regulator got criticized for being too slow, too cozy, or too confused. A Binance-scale issue in 2025 would trigger instant statements from US, UK, EU, and Hong Kong authorities. You'd hear language like protecting customer assets, working with international partners, and monitoring market stability. This does two things. It calms some users, but it also tells big institutions, step back until the dust settles. That pause from the institutional side is what creates the second-day dip. Second, centralized exchanges would distance themselves fast. When FTX fell, Binance stepped in briefly, then walked away. In a Binance event, the reverse would happen. Coinbase, OKX, Bybit, Kraken, Bitstamp would all issue "we have no exposure" statements, proof of reserve links, and, in some cases, fee-free withdrawals to hoover up fleeing users. That scramble for trust would actually be healthy for the ecosystem. It would accelerate the move to exchanges with clearer regulation and clearer banking relationships. Third, DeFi would temporarily spike in usage. Just like after FTX, people would say, "I'm tired of CEX risk, I'm parking in DeFi for now." We saw TVL jump in Aave, Curve, and GMX after FTX. We'd see it again, possibly bigger, especially on Solana and Ethereum L2s, because they're faster and cheaper than they were in 2022. But, and this is important, DeFi does not yet replace CEXs for on-ramping and for very large OTC-style flows. So DeFi would be the safety parking lot, not the final destination. Fourth, Bitcoin would dip, then probably outperform. That's exactly what happened in 2022. When FTX blew up, everything sold off, but Bitcoin and ETH recovered first, because they were the assets people trusted most. In a Binance panic, you could absolutely see Bitcoin spike down, say from 101,000 to 95,000, but then reclaim faster than altcoins because people would rotate to quality inside crypto, not out of crypto. Especially now that you have ETFs in the US, Hong Kong, and soon Australia, there are simply more safe crypto rails than there were last time. So what's the real lesson here? It's that centralization risk never went away. We learned it with Mt. Gox. We learned it again with FTX. We pretended to learn it with Celsius, Voyager, BlockFi. And yet, because centralized exchanges are convenient, fast, and liquid, users always drift back. That's human. But it means the industry has to think in terms of blast radius. An FTX-level blast radius hurt traders and some chains. A Binance-level blast radius would hit market structure itself, price discovery, altcoin liquidity, stablecoin routing, and importantly, public perception. Headlines wouldn't say one exchange failed. They'd say, Crypto's biggest exchange under pressure. That's why this scenario is worth running, even if it never happens. So what do you do with that as a listener? 3 things. 1. Never keep trading size and long-term holdings on the same venue. Your hot wallet and your savings wallet should not be the same thing. 2. Watch exchange proof of reserves, but don't treat them as gospel. They're a snapshot, not a guarantee. 3. Diversify your entry and exit ramps. If you only know how to get money on and off crypto through one exchange, you are voluntarily taking single point of failure risk. The good news is, the industry is better positioned for a shock in 2025 than it was in 2022. There are more regulated venues. There are more ETF rails. There are more on-chain options. There's more transparency. But the bad news is the same as always. The bigger the hub, the bigger the hole if it breaks. And Binance, love it or hate it, is a hub. That's today's deep dive. If you found it useful, make sure you're following the show wherever you're listening, drop a 5-star rating, and tell us what scenario you want us to run next. Tether under stress, a layer 1 outage, or a coordinated regulatory hit. We can model any of them. This is the Daily Crypto Deep Dive, and we'll see you at the top.